are going to be told about 1,000 times over the next couple of days that you have a big week ahead, because you have a big week ahead. Chairman Powell coming up tomorrow. He'll speak again on Wednesday on Capitol Hill in his semi-annual testimony, going into payrolls on Friday, then on to CPI next week. Futures going into the opening bell to begin trading this week. Positive 0.2% on the Nasdaq, up 0.4%. Switch up the board and get to the bond market. Yields look like this, retreating from last week's high levels, cycle high. On a 2-year yield, on a 10-year yield, the highest since November, we were north of 4%. We're sub 4% now, 392.44, down about 3 basis points. On a 2-year at the front end, we retreat as well by 2 basis points to 483.38, about 11 basis points below the highs of last week. In the FX market, euro dollar 106.59, up by 0.2%. Mr. Philip Lane over at the ECB talking up more rate hikes. Maybe we talk about another 50 after this month's 50 from the ECB. And just finally, crude just below 79.80-ish, 79.15 at the moment. We're negative 0.7% on WTI crude. About 45 seconds into the session, we are positive, just about 0.2% on the S&P. On the Nasdaq, up by 0.5%. One stock to watch at the open is Apple. Goldman initiating coverage on the stock with a buy rating, 199 price target, expecting the company's large user base to fuel growth in its services business. Abby has more. Hey, Abby.
Hey, John. Well, yeah, this is a big call because, of course, Goldman being one of the premier investment banks in the world, now making a big call on one of the premier companies in the world, the largest company in the world, in fact. But you can see over the last year, this stock has basically been stuck in a range. On the year, it's up about 18%, but over the last year, down just a little bit. So we have this new analyst in town at Goldman who is taking a more constructive view. This is their first buy rating on this stock really in many years, after having been on the sidelines actually for many years. The last buy rating 6 years ago. Now they are positive on the mix shift. You were just talking about that user base. What it means is they might be able to diversify away from the iPhone. We've been hearing a lot about this over the last several years, more into services, which is about 20% of the business, to bring that part of the pie up. So you'd have that old legacy business, but then you could layer on the new growth. Now the firm's $199 price target suggests about 30% upside from current levels. Since the last buy rating, this is really incredible. Apple is up 300%. The S&P 500 is up 60%. But the thing that they both have in common, clearly, are big gains. The S&P 500 being up 60% seems small relative to that 300% gain, but that's nothing to sneeze at all. So as much as a call as this is, John, on Apple, you could also make the case that perhaps it's also a call on the market for 2023.
Interesting point, Abby. Thank you. Apple's up by about 2%. As Abby pointed out, that's the first buy recommendation on Apple from Goldman in nearly 6 years. Just to bring you a little bit more of that note, just an extra flavor of it. Apple's success in premier hardware design and resulting brand loyalty has led to a growing installed base of users, which should more than offset cyclical headwinds to product revenue. Big call from Goldman. Stocks up by about 2% this morning. Another one to look at, Tesla, cutting prices on its 2 most expensive US vehicles for a second time in just a few months. Elon Musk saying the following at Tesla's Investor Day: "We found that even small changes in the price have a big effect on demand." Katie Greifeld has more. Hey, Katie.
Hey, John. Well, you actually have Tesla shares down slightly on that news. They've been bouncing back and forth. We'll continue to keep an eye. But this latest round of cost cuts comes just 7 weeks after they cut costs on these models back in January. And in addition to the quote you just read, Elon Musk also said last week that demand will, quote, go crazy as the company makes its cars more affordable. So let's get into some of the numbers here. The models in question are the Model S and the Model X. That includes the high-performance versions of those cars as well. You can see the Model S now starts at $90,000. That price tag was 6 figures coming into 2023. The basic Model X now starts at $100,000. And again, the fact that we're seeing price cuts again so soon after the latest round suggests that these models maybe got less of a sales boost from that other round of cost cuts than expected. And we know that Tesla needs to boost demand, even though Elon Musk again said last week that the desire to own Teslas was, quote, indistinguishable from infinite. Production has outpaced sales for 3 quarters. And in the 4th quarter, you can see there that Tesla made 34,000 more cars than it actually sold. And that ratio has been getting worse, John.
Katie, thanks for that. The stock's just a little bit lower. Is it a case of our sales prices, our cuts, your problem? Maybe. Dan Ives of Wedbush says this: Tesla cutting Model S and X prices, another smart strategic move by Musk and co. He says Tesla is in a position of strength on price cuts. We know Dan's bullish, so that's the bullish take on things for you right now. Here's another take. It's Morgan Stanley. They've removed Tesla as their top pick in US autos. They've replaced it with Ferrari. The analyst writing, quote, building on their learnings from hybrid and applying their racing DNA, we believe Ferrari can offer an EV that will be just as high in demand. I can't get my head around Ferraris and EVs, but that's a story for another day. Another blow for Credit Suisse. Let's talk about that bank, Belegan. The effort to win back clients is a struggle, and one of the bank's biggest backers, David Herro, has sold his entire stake in the lender. This is what Herro told the Financial Times over the weekend. The plan to restructure the bank is cumbersome and far more costly in terms of cash burn than we expected. We were also not satisfied with what we were getting in terms of proceeds from the sale of securitized products. Shanali's been following the story. Shanali, find me some good news for this company right now.
Listen, this is the sale that you're thinking of here, the securitized product group. These are what happens when you sell things in a down market, John. You're just not going to get what you get when you try to sell things when things are good. Now remember, David Herro in particular has held the bull by the horns for a very, very long time. Credit Suisse never regained the former glory of the pre-2008 era, and remember, even now he's selling at historic lows. He told the Financial Times he started selling around October when the Saudi National Bank took a stake. If you take a look now, what's interesting about the top shareholders of Credit Suisse, you are looking at a group that is largely contained in the Middle East. That is the Saudi National Bank, that is investment vehicles tied to Qatar, QIA, and now the Orion Group, with the exit of David Herro, also becomes a top 5 shareholder. So as the bank shifts towards international wealth, they now have a hefty group of Middle Eastern backers on their side. Now, I also want to take a look at a popular trade here, because more than the shares, you are looking more at the credit default swaps of Credit Suisse trading more actively, because you are looking at CDS that has widened pretty meaningfully this year. It's not at the wides that you saw early this year or even last year. It's not a meaningful risk of default you're seeing here in the bank's shares in CDS, but what you're seeing is a concern among investors that is reflected by David Herro's view that it's not a risk of crashing, it is the risk of limping along. The question now with potential outflows this year is how long do they limp along for, and do they meet the new goals that they've set forth?
Just as the rest of the industry recovers in a major way across Europe. Shanali, thank you for that. And I'm talking specifically, almost exclusively, about the stock price over in Europe right now. Look at Credit Suisse year to date, now negative on the year. Look at UBS, up close to 20%. Look at the overall universe of Eurozone banks outside of Switzerland, up 24% on the Euro Stoxx 50 for the European bank names right now, year to date. And over the last year, even bigger moves than that. David Herro spoke to this in the FT. He said rising interest rates means lots of European financials are headed in the other direction. Why go for something that is burning capital when the rest of the sector is now generating it? To discuss, Sharon Bell at Goldman Sachs joins us right now. Sharon, wonderful to catch up with you. I remember you said a number of months ago on this program you liked European banks. It's working out. What's great about them?
Yeah, it's been the perfect environment for European banks. You've had growth pick up in Europe. We've had higher interest rate expectations, and banks enjoy an environment really of higher interest rate expectations, increases their net interest margins. So it really has been a kind of a perfect recipe for the bank sector. And they started off with quite low valuations. The earnings season was extremely good, both the third quarter one, but the fourth quarter one was really above expectations. So it's absolutely been perfect for the European banks.
Sharon, we've had this story of a valuation gap between Europe and the United States beyond the banks at the index level for quite a while. It was a valuation trap for quite a while. I take from your stance, Sharon, you think that's really changing, that valuation gap is not warranted or deserved. And I was going through your work and you said you were looking across utilities, staples, energy and banks. What do you see there across those 4 areas?
Yeah, there are quite a few sectors in Europe. So first of all, I would say, yes, there is a big gap between US and European valuation. Do I think it should close entirely and Europe should trade on the same PE multiple as the US? Absolutely not. The US has higher growth companies. It has a much bigger tech sector that tends to attract a higher valuation. So I wouldn't expect it to disappear. But yes, every single sector in Europe trades on a discount to its peer sector in the US, and that discount is generally quite big versus the past. Consumer staples, which perhaps aren't in fashion at the moment, they're a defensive area and growth is improving a little bit, but they trade on a big discount in Europe relative to similar names in the US. The energy sector is one of the ones with the biggest gap though. You mentioned that sector. It trades on a much flow multiple in Europe than it does for its counterparts in the US. And really, they're in a very similar business. So we do think the gap should close a little bit for quite a few different sectors.
Sharon, just on energy specifically, can you explain that valuation gap because of a windfall tax, a regulatory push in Europe that maybe doesn't exist here in the United States? Does that explain it?
Yeah, so there's a little bit of that. I mean, bear in mind that the companies in Europe, the large European energy majors, make their profits globally, and they will pay their windfall taxes where they make the profits. So some of these windfall taxes will be put on US companies that also make money in Europe and elsewhere. So yes, I think a little bit for the windfall tax risk and imposition. I think also quite a bit for the fact that ESG funds tend to have very low weights if they invest at all in the big energy majors in Europe, whereas obviously those funds have grown everywhere, but particularly in Europe. So I think those are the factors that keep European energy stocks at a big discount. But in terms of who wants to buy energy stocks at the moment in Europe, actually you don't really need a buyer outside of the sector itself. The energy sector is buying back shares. So we've seen huge buybacks in the last year. I expect them to continue this year. They're the biggest buyer at the moment of energy stocks.
Sharon, for a long time we talk about the index level, Europe versus the United States, and the easy explanation for the discount was just the sector mix that existed in the United States, much heavier in terms of tech, which explained that valuation premium. Sharon, do you think then, looking at the sectors, adjusting for that it goes beyond that?
It absolutely do. So every sector in Europe is on a discount to its US sector. So even if you do put them on the same weights, use perhaps global sector weights to weight up the valuation of US sectors, do the same for Europe, you still get a big gap. You can perhaps close about a third of the gap difference between the US and Europe, just putting them on the same sector weights, but still 2/3 remains. Some of that's Europe's typical discount to the US, and I understand why Europe should be on a bit of a discount. Lower growth economically in Europe, perhaps a little bit more sovereign risk in Europe. But the discount at the moment is particularly large, and it's true across lots of different sectors. And tech is a good example. There's a discount for Europe, a very small one between European tech and US tech, but actually in the next couple of years, based on the consensus, European tech has a better growth forecast than US. So should it really trade on that type of discount still?
Interesting. That's what I wanted to talk about, just to finish on it. The next year or so. So Sharon, year to date, great call. It's materialised. I can see the moves. France earlier this morning, another record intraday. CAC 40 year to date up 14%. Germany up 12%. Spain up 15%. Italy up almost 18% year to date. There might be some people who weren't in this trade, Sharon, that saw that and just thought, okay, I've missed it. I don't want to go there. What do you say back to them?
Yeah, I think Europe can outperform the US, but I wouldn't expect super strong returns from here for either side of the Atlantic. I think the problem is we've already priced in a lot of sort of the potential improvement in growth. We've already priced in a lot of that. And of course, interest rates are rising. Those sort of rising interest rates expectations mean there's another asset class you can potentially invest in and get a risk-free or close to risk-free return in bonds, sovereign debt, in cash even. So I think the attractiveness of equities relative to those has come down a bit given the performance. But having said all of that, I do think Europe looks cheap versus the US. You still get a good income and dividend from Europe. You're still kicking off quite a lot of cash. The companies are buying back shares. And European growth has improved quite a bit. So all of those things mean Europe probably outweighs the US in terms of, investor returns for this year, in my view.
Just massive moves already year to date. Sharon, thank you as always. Sharon Bao there of Goldman Sachs on the European story and the outperformance we're seeing in Europe year to date so far. Higher rates helping out the big banks. At some point, even higher rates become a problem. I have no idea how far or how close we are to that moment. The S&P 500 positive 0.4%, about 13 minutes into the session. The Nasdaq up by 0.5%. Coming up next, US lawmakers taking aim at tech in China.
In terms of foreign technology coming into America, we've got to have a systemic approach to make sure that we can ban or prohibit it when necessary.
That conversation still ahead.
In terms of foreign technology coming into America, we've got to have a systemic approach to make sure that we can ban or prohibit it when necessary. We've got 100 million Americans on TikTok 90 minutes a day. They are taking data from Americans, not keeping it safe. But what worries me more with TikTok is that this can be a propaganda tool.
US lawmakers stepping up the push to ban TikTok. President Biden closing in on an executive order to restrict US investments in China tech. The administration writing in a report seen by Bloomberg that the objective is, quote, preventing US capital and expertise from being exploited in ways that threaten US national security while not placing an undue burden on US investors and businesses. Team coverage starts right now with Bloomberg's Anne-Marie and Katie Lyons down in DC. AMH, talk to us about what's on the table here.
Well, Jonathan, you just see Washington continue to address the Chinese Communist Party and adding more tools to their toolbox. One comes from the White House and the other is from the other side of Pennsylvania, coming from lawmakers. So first you have the White House. This is really a long time coming. Reports for months about this executive order. But what would it do is restrict investment into certain parts of the Chinese economy. These parts, the administration think that this advanced technology that this investment would go to could enhance either the Chinese Communist Party military or as well as their intelligence capabilities. And we may get more details about it today because Biden will be unveiling his budget on Thursday, this week. And then the second part of this is just another bill that either it names TikTok or not, it will go after TikTok. You have Senator Warner on Fox News on Sunday saying that this has broad bipartisan support. He's working with South Dakota Senator John Thune, and this would basically ban this kind of technology in the United States. But this has to be the sixth or seventh bill that is going after TikTok. So at some point, one of these, you imagine, is going to get across the finish line.
Well, I just wonder how narrow this might be. Anne-Marie, just reading that language, technologies that could enhance China's military and intelligence capabilities. Based on what they've been saying, is TikTok part of that?
Well, that's a great question. If you think about intelligence capabilities, TikTok could potentially be part of that because many view it as the Chinese Communist Party is able to, because TikTok is owned by ByteDance, a Chinese company, is able to gather intel and data on these users in America. But we should note, Jonathan, and at the end of the month, the TikTok CEO will be in Congress. He will have a hearing and he will be testifying. They are spending billions of dollars really on this project called Project Texas. They're working with Oracle. What they want to do is make sure they can show CFIUS, U.S. lawmakers, that there's a way that they could still remain active in the U.S. and keep the U.S. data safe in the United States. And they're working with the European Union as well for something similar in Europe.
And Katie, two words here that stand out: capital, expertise. That's not just money, that's talent too.
Yeah, exactly, John. But the money, of course, is ultimately a good deal of what matters to the markets. And when you talk about technologies that could limit the advanced military and intelligence capabilities of China, this could reach into a lot of different areas of Chinese technology, including chips and chip makers, makers of manufacturing equipment, anything related to AI and ChatGPT and quantum computing as well. So as a result, you are seeing this show up in the ADRs of some of those companies, the likes of Alibaba and Baidu, BDD, all down this morning, even about 2% in the case of Baidu and PDD. And when you look at the Golden Dragon China Index, which of course tracks a basket of those stocks, it is down about 1.3%. All of these, of course, listed here in the U.S. John, we had seen years ago a big boom in IPOs of Chinese technology companies here stateside. Alibaba, of course, back in 2014. That has started to trickle off. In 2022, there was only about $500 million worth of IPOs here. It has gotten a lot more difficult due to the headwinds around geopolitics and, of course, a lot of questions around auditing as well. This now would add another layer on that investment difficulty and adds another layer, perhaps, of difficulty for these stocks because we know, John, over the last several years, these have been underperformers. Yes, the Golden Dragon China Index is up about 70% from its low back in October, but still over the last 2 years, it's down roughly 57%. And Chinese stocks as a basket dramatically underperforming the rest of the world, down about 40% over that time compared to the All-Country World Index, down just about 2.3%, John.
Wow. AMH, I just want to give you the final word. Away from the equity market just for a moment, just on the politics. We heard from the former President Donald Trump over the weekend campaigning. We heard from the governor of Florida, I won't say campaigning, but certainly on the media tour still, ahead of potentially announcing he's going to make a run. Is China going to be a big feature of this upcoming election in 18 months' time?
Well, it absolutely is. What did you see this morning with the Daily Mail? An opinion piece from the former President Trump talking about COVID and how he wanted to go after the World Health Organization because he thought they were deferential to China in the beginning of this, because also we've had recent reporting coming from the Department of Energy that they say this was a lab leak potentially. So, Jonathan, China, whether or not it's COVID, whether or not it's investment, whether or not it's the data, many lawmakers say they are harvesting in this quote-unquote Trojan horse, the United States, through TikTok. China will become this #1 enemy for lawmakers, not just in the GOP, though. This is going to be as well for President Biden, who's expected to make his campaign as well. He's going to show all that he's done while he was in power to try to make sure that they are competing with China and keeping American data and money safe.
MH outside the White House, thank you. Kelly Lyons down in D.C., thanks to you too. Big story over the next 18 months, that's for sure, potentially anyway. Into the equity market, 23 minutes in, we are positive by 1/3 of 1%. Let's get you some sector price action. Here's Abby.
Yeah, John, and that is the first 3-day upswing for the S&P 500 that we've seen in more than a month, the most that we've seen the S&P 500. So not surprisingly, we're looking at bullish sector action. Tech really helped out by Apple. We also have some of the other mega caps following along, communication services. And just to tie the bow on the bullish year so far, take a look at technology, the best sector, the 3 down sectors this year, John, they're all defensive.
Abby, thanks for that. Up next, your trading diary.
Day like Bloomberg.
Almost 26 minutes into the session this morning. Good morning to you. Equities broadly positive by 0.4% on the S&P. On the Nasdaq up 0.6%. Let's get you to the trading diary. What you need to be looking for. Top of the hour, US factory orders and durable goods. On Tuesday, Fed Chair Jay Powell kicks off 2 days of testimony on Capitol Hill. ADP numbers, monthly JOLTS report coming up on Wednesday. President Biden releasing his budget proposal on Thursday. And finally, the big one on Friday, the payrolls report to round out the week. A sneak peek of our survey. A moving target, but a median estimate so far, 223,000 for Friday's payrolls. From New York, this was the countdown to the open. This is Bloomberg.
from the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Monday, March 6th. Here are the top market stories we are following for you at this hour. Buckle up. China's NPC is underway. Chairman Powell is preparing to testify in Congress, and payrolls are on deck. It's going to be a big week. Throwing in the towel, David Harrow sells Harris Associates' entire stake in Credit Suisse, ending ties with the bank after about 2 decades of ownership. And views from J.P. Morgan. Ken Foley, the bank's global head of debt capital markets, is coming up this hour. And in the next hour, an exclusive interview with Chairman and CEO Jamie Dimon. From Washington, D.C., I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is on assignment. Welcome to Bloomberg Markets. Guy, just taking a deep breath because it's going to be a big one.
Yeah, it's going to be a massively busy week, isn't it? We're kicking it off with a busy Monday, but we've got a long way to go. Really interested to hear what Jamie Dimon has to say in the next hour about what is happening here. Let's talk about the data we're getting right now because, as you say, information is going to be coming thick and fast this week. Jay Powell tomorrow, but we've obviously got payrolls Friday. We've got lots of central banks reporting this week. Factory orders out slightly better than anticipated, coming through at negative 1.6. Ex-transports plus 1.2. That's again slightly better. Durable goods coming at negative 4.5, bang in line with estimates and bang in line with the previous number. Ex-transport, again, a little bit better. That seems to be the narrative at the moment. At the margin, maybe the data is a little bit better. We know what's happening with services right now. They are certainly, in certain areas, you take a look at what's happening with hospitality, appearing to re-accelerate. But our question of the day is a fairly straightforward one. Is this the biggest week of the year? And the question we're really asking here is, we're all confused by the economy. We're all confused by the reaction function of central banks to the economy. Is this the week we start to get significant amounts of clarity around that, and how are markets going to react given current positioning? To try and kick this around, Bloomberg's Mike McKee and Katie Greifeld join us on set. Let's talk about this. Mike, I'm going to start with you. Are we going to get clarity this week from Powell? The data are turning up stronger and stronger and stronger. What is Powell going to say that's going to give us a clear sense of direction as to where we go next? What's he going to say?
Well, I wish I could tell you he was going to give you a whole lot of clarity. I mean, just basically, we can't say this is the biggest week of the year because then nobody will tune into your show for the rest of the year once this week is over. But Powell's problem is, as you pointed out when you were going through the calendar of events, is that the things that the Fed is watching, we won't know that data until after he's done with testifying. I mean, they've said that the labor market is extremely tight. They tie that to the JOLTS report. That's out on Wednesday. The jobs numbers don't come out till Friday. And then we get CPI the following week, all that ahead of the Fed meeting. So the chairman can't really take a position on what the Fed's going to do or how far they're going to go until they see whether the January numbers were a one-off, whether we regain any progress on inflation or not. So I suspect he's going to basically stick to the Fed's script so far of higher for longer without specifying what either number is.
Well, Katie, even if he sticks to the script, that doesn't mean that market participants aren't going to try to pick it apart word for word. So in terms of how positioning is right now, what kind of catalyst realistically could we be looking at?
Well, that's the thing. Stakes are pretty high in the market, even if we don't necessarily get new information from Powell, from what he's going to say, and we'll see what kind of questions he gets asked. But if you look at what markets are pricing in right now, you're looking at a Treasury market where the 10-year yield is hovering below 4%. You're looking at an S&P 500 that bounced pretty convincingly above that 200-day moving average last week. We'll see if those levels hold or whether we get something a little bit more dramatic. In addition to Powell, of course, we have the payrolls print, and maybe Mike remembers this better, but in my memory, this is one of the first reports where I've been more excited for the revision to last month's numbers than the actual headline numbers that we're going to get on Friday.
Plus or minus 300 seems to be kind of where we are. You get plus 300, life gets quite exciting. Not on the revision, on the actual number for this month. Katie, just talk to me about positioning, though, a little bit more. We've come a long way very quickly in terms of particularly bond market positioning. We've priced in a lot more recently, and I'm wondering, therefore, kind of how symmetrical the risk is around this week. Is the risk symmetrical, or is the risk that we are more hawkish or less hawkish?
Well, you're right. I mean, it's been a stunning repricing in the Treasury market. If you look across the curve, there was a beautiful moment last week. We were above 4% on every single tenor. After this big rethink that we've seen in the bond market, and we know if we look at some of the futures positioning data that people are very short the Treasury market right now. If Powell sounds anything close to dovish, maybe that's the bigger surprise, since right now the thinking in the bond market at least is that this is a Fed that's going to stick to the script and it's going to raise rates. They have not wavered in that commitment from the top down.
Mike, on the subject of surprises, something else surprising over the last 24 hours or so was the growth target coming out of China. Many anticipated it would be greater than 5%, but that is what they're sticking to on their GDP target for this year. Does that help the Federal Reserve?
Not particularly. It looks like so far this year that trade with China has remained about the same as it has been. And even if they do ramp up a little bit from the 3% growth of last year, we're not seeing the move in the commodities market that would suggest there would be a big impact one way or another. So at this point, it's probably something the Fed keeps an eye on, but not a major impact on their thinking.
Is it a bigger problem for the ECB, Mike? It was interesting. Buried within what was announced over this weekend was a much greater focus on consumption. So today in Europe, you've got commodity stocks like Glencore, et cetera, trading lower. But you've got more 52-week highs in the luxury stocks because that's where the narrative is moving. They've been moving in that way for a while. But nevertheless, is this going to be, if we do see this playing out, is the ECB going to have a bigger problem with that?
Well, it is maybe more of an issue in Europe because of Europe's trade ties to China, but it's probably also not going to be as big a deal as the inter-Europe trade that goes on, because at this point, Europe has slowed. Whether or not it has a recession or not, people aren't buying as much across the European borders. The question with China is there are efforts by the Chinese to try to get people to consume more. There was a feeling that coming out of COVID-0, there would be revenge buying. People would go out and spend a lot of money. But the anecdata that we're getting out of China is that people got used to kind of saving their money, and they don't have the social safety nets that we have around the world in places like the UK, the US. And so maybe savings continue to rise there. Maybe people continue to put the money away and they don't start buying a whole lot of stuff. That remains to be seen.
All right, we'll leave it on that note. Bloomberg's Michael McKee and Katie Greifeld, thank you both so much for joining us. And coming up, we'll get more on our question of the day. Is this the biggest week of the year? Either way, you should probably still keep watching this show. Eric Friedman, U.S. Bank Asset Management CIO, will join us next. This is Bloomberg.
Exclusive today. JP Morgan Chase CEO Jamie Dimon sits down with Bloomberg's Ed Hammond. Live from the JP Morgan Global High Yield and Leveraged Finance Conference in Miami. Only on Bloomberg TV and Radio.
We have the payrolls report on the 10th. Non-farm payrolls, a big important print.
Chair Powell this week.
Chairman Powell will appear in front of the Senate Banking on Tuesday and then House Financial Services on Wednesday.
I think they'll stick to the script.
We expect him to deliver, the messages that he has been.
We still have a high inflation environment.
He will underscore the fact that inflation continues to be their main objective.
Whether you get enough of the information or before the next Fed meeting.
What actually happens in terms of the questioning of Powell is another thing.
We just have to see how the data develops.
We've got key data coming up.
We're certainly all beholden to the data at this point.
The proof is going to be in the pudding.
The Fed is data dependent. We are data dependent. The market is data dependent.
As I said earlier, buckle up. Investors are gearing up for a lot of important information coming out this week, which gets us back to our question of the day. Is this the biggest week of the year? Joining us now is Eric Friedman, U.S. Bank Asset Management CIO. So, Eric, can we all go home after this week?
I wish we could, Kaylee. I think that my basketball team and my picks for my bracket may be going home this week, but probably not for investors. I do think that the points that the other guests have made are really spot on with respect to just the confluence of data coming in. Obviously, non-farm payrolls. Hopefully, we get a couple morsels from Chair Powell Tuesday and Wednesday before things get really quiet ahead of the Fed. But again, I think that mortgage applications, which is probably a less talked about variable, is a key data point this week as well, just because we have seen a pickup in rates. Probably won't be captured in this data set, but of course we have a really important jobs data number on Friday. So I think it's a really key week, but the Fed's really after optionality, Kaylee. I don't think they're going to commit to anything significant because this has to play out over the next couple of months as opposed to the next couple of weeks.
Eric, when do you think we are going to get clarity on what is happening here? It's been an incredibly confusing start to the year. As Kelsey was saying, we're all data dependent right now, but the data's bopping around all over the place. When do you think investors are going to be able to invest with a degree of conviction?
Yeah, I think there's things you can do right now, Guy, with conviction. The first part would be the front end of the yield curve. And if you look at a 6-month or 12-month T-bill, even though it's becoming more commonplace conversations among strategists like me, that's a place where you can invest with some certainty. We just haven't had that opportunity for some time. And so that'd be the place we'd invest with confidence, even if we see the Fed continue to pick up their verbiage around higher for longer. So that'd be the first place we'd start. I do think that the conviction around things like lower profit tech is probably not until a back half of this year. We're stuck in this trading range, Guy. We're between S&P 3,800 and 4,200. I think until we see a break above either of those levels, either above 4,200 or below 3,800, this is a trading range environment. And we do think the inflation data will be what really drives that move. Again, we think that economic gravity is going to set in at some point this year and probably into early next. So we're a buyer, a little bit lower from here. But we do think that there are things you can do with conviction right now. We start with the front of the yield curve as our highest conviction idea.
So does that mean that you don't see a role for cash right now? Because in our latest MLive survey of over 400 respondents, 2/3 of them said cash in their portfolios would bolster rather than drag down their performance in the year ahead. What's your view?
Yeah, I think that cash defined as, let's call it, very safe paper between 0 and 24 months of maturity is a great spot to be. Now, we do think that the pendulum will probably shift to being a bit too bearish if we see that inflationary data pick up. So I think the risk is that investors get lazy and really hang out on the front of the curve for too long. But for now, it is a good place to get into. We think that probably the back half of the year, early next year, when we have a little more clarity about that break higher or lower is where you can get involved a little bit more aggressively. But again, 0 to 24-month paper is a great spot to be right now.
Can I just go back to the 2-year as well, Eric? We're just sub 5% right now. There's talk the Fed could go to 6. There's some talk that the Fed could go even higher than that. I appreciate that the duration is relatively short, but nevertheless, do you still think that we could be seeing higher yields here? That actually there could even be a better entry point when it comes to even the front end of the curve?
Yeah, absolutely, Guy. I think that one of the nomenclatures around Wall Street right now, which is I think a bit of a misnomer, is this concept of reinvestment risk, which is, hey, look, don't get involved because you may be able to get involved at higher yields later, which may in fact be the case. But we wouldn't pass up the opportunity right now. Again, we would stay, whether it's in non-taxable bonds, so let's call it 0 to 24-month treasuries, or taxable munis. You look at between 0 and 18-month paper on a tax equivalent basis. There's a lot to do for investors. So agreed with your point that certainly there's the risk that the Fed does get even more aggressive, and so owning 2-year paper maybe doesn't make sense. I'm not saying put everything there, but we do think staggering things out over that 0 to 24-month maturity cycle and to keep reinvesting that cash for some time, we think is a really meaningful strategy right now.
What about ex-U.S., Eric, especially in light of a China that may be growing less quickly than we might have anticipated China would aim to grow this year?
Yeah, Keely, I thought that the rhetoric over the weekend from China was interesting. They certainly set the bar a little bit lower than maybe what some had thought. And I think that the reality is that transmission of Chinese activity is probably a little less focused on what we're used to, which is big infrastructure spend, and more on a highly variable data set, which is what consumers will do. So I do think that while you're seeing that reopening happen, it's happening in a very, very staggered basis. And we think the slow impulse you'll see from a variety of sectors is just going to be, again, delayed in nature. So we actually have been a little more favorable on non-U.S. over U.S. over the past few months. It's served us well. Yep. But, again, it's probably going to be a little bit of a tug of war as we get deeper into this year, as we see some of that inflationary data in Europe probably pick up in particular.
If you are going to invest in the U.S. and you're going to invest in U.S. equities, where's the spot, Eric?
I'd say, Guy, infrastructure and energy would be the two places that we're most excited about right now. You're getting some cash flow with infrastructure. You get a little bit of benefit as ports reopen, as you're seeing a little more activity running around the world. That's going to be a benefit. So we'd be really focused on cash flow in particular, again, in this range of 3,800 to 4,200. Cash is your friend, dividend and yield is your friend. That's a great place to hang out for optionality.
Eric, thank you for hanging out with us. We greatly appreciate it. Really, really important input. Eric Freeman, U.S. Bank Asset Management CIO. Thank you very much indeed. Still ahead, Tesla is slashing prices for the second time this year as competition in the EV market revs up. Apparently we are learning about price elasticity over at Tesla. We're going to have details next. This is Bloomberg.
Questions.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Goldman Sachs is losing stock trading rainmaker Joe Montesano. Montesano was a key player in the firm's ascent to the industry's #1 rank in equities for 2 straight years. As a result, his pay rivaled the $75 million awarded to Goldman CEO David Solomon over a 3-year period. Montesano doesn't have another job lined up. The new Formula One racing season began over the weekend in Bahrain. Red Bull's Max Verstappen began his defense of back-to-back titles by winning the race. Formula One has become a sensation in the US, thanks in part to the Netflix series Drive to Survive. We spoke with Red Bull team principal Christian Horner.
We've seen massive growth. I think that the whole phenomenon through Drive to Survive has just introduced Formula One to a whole new audience, a younger audience, and very much an American audience. So I think out of the 25 new partners that we've introduced in the last 3 years, 21 of them are US based, and 3 of them are in the Fortune 500. It's just, Formula One is on fire at the moment.
The US will host 3 Formula One races this year. For the second time this year, Tesla is cutting prices. The electric car maker is reducing the base price for its Model X by $10,000 to just under $100,000. The Model S will be cut by $5,000 to just under $90,000. In January, Tesla slashed prices by up to 20% to boost sales. And that is your latest Business Flash. Guy.
Rick, thank you very much indeed. 21 minutes past 7 on the West Coast. Time to go to the startup, a little earlier than normal. We're covering the top tech stories from the Bay Area and beyond. Silicon Valley starting its morning a little more overcast than it's been recently in San Francisco. Ed Ludlow up bright and early to take a deeper dive into this Tesla story. Ed, they seem to be discovering price elasticity.
Yeah.
If we lower prices, we get greater demand.
Yeah, I think that's the right read. The reason I love that shot that you just showed is that if you panned just a little bit right, just a little bit, we're actually pointing at the Fremont factory where Tesla manufactures the Model S and Model X, including the plan. But that's perfect. Who did that? Exactly, just there.
You.
Stop. That's right. So in that general direction is where this is going. Now, they only make 100,000 of these a year, but you're exactly right that what we see Tesla doing is cutting prices more than once in quick succession, right? So there's 2 ways of looking at it. They cut prices on the S and X in January 12th. They're doing a deeper cut now, and if you take that aggregated cut, it's double digits, right? In some cases 20%, but they seek out pockets of demand. And it's interesting to see that automakers around the world following suit.
I just have to give a shout out to the control room for that one. That was some TV magic right there, Ed. Yes, in theory, this is about stoking demand, but how much of it is also about just qualifying for EV tax credits?
Yeah, I think in the United States, this is a particular issue, right? Again, Model S and Model X are a very small volume production, but part of unlocking demand is making them available for incentives, right? That's what Tesla's earlier cuts did. And when Ford cut the price on the Mustang Mach-E, they did so in part chasing Tesla's tail, but also to add eligibility. But then there's the China story. China has nothing to do with the IRA or the incentives available in North America, and we see a price war developing there, and particularly in the equity market side of this story, investors really jostling for position. We started or ended 2022 with BYD, for example, the Warren Buffett-backed EV maker, raising prices. But now what you see is their dealers cutting, and the stock has really dropped at the start of this year compared with Tesla's gain.
Ed, one of the reasons why everybody's always liked Tesla is it has a degree of exclusivity. And that has meant that even in downturns, I'm not sure we've seen a significant downturn, but in theory, that means that they are relatively protected because the upper echelons of the income scale spend more and are less susceptible to stopping spending.
Yeah.
Does Tesla now move away from that? And is that why Morgan Stanley thinks you want to own Ferrari over Tesla?
Okay, well, there's 2 points to that. Go back to Master Plan Part 3, what we saw last Wednesday, and we don't know what the next two models are. We don't have specifics, but there is this idea that actually Tesla has to broaden out to more mass market models, higher volume models. We've talked a lot on this show about the average price of a new vehicle in America being $47,000 or so. Tesla's actually below that. The Ferrari call from Morgan Stanley really interesting because they are actually leaning into the exclusivity. They point to Ferrari's backlog, the visibility they have for strong earnings, the ability to use pricing power because there's still demand at the higher end of the market. You talked at the beginning of this segment about elasticity. Tesla is kind of not in that sort of as strong position right now. It's having to use price cuts to unlock new pockets of demand. And Morgan Stanley is saying for us, Ferrari actually still has the stronger positioning to use those levers. Let's go with it.
Just quickly, Ed, we're talking about Tesla as a car company here. I thought we also were supposed to be valuing Tesla as a battery company, for example.
Yeah, and again, a big part of Master Plan Part 3 was how we get to overall output from the company in terms of kilowatt hours, not just in the vehicles, but energy storage, stationary storage, fixed storage. For them, that's why they also have to focus so much on supply chain because they're having to feed both of those businesses, and they're very bullish on it in the long term, right, that actually the energy side of their business will see more demand.
All right, great stuff. Ed Ludlow in San Francisco. A beautiful morning in San Francisco. Thank you very much. Now coming up, we'll turn to another corporate story we are watching. It is another blow for Credit Suisse in its battle to win back clients. Someone who has been holding on to their investment for so long has finally thrown in the towel. We've got those details coming up next. This is Bloomberg. We're an hour into the U.S. trading session, kicking off what is going to be a big week for investors. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, Monday morning not shaping up too bad.
Yeah, we have another gain here for the S&P 500, Kelly. The S&P 500 up for a third day in a row of about 3% over this time period. The longest winning streak since the beginning of February and the best winning streak. So the bulls taking charge after a bullish week last week. When we break it down a little bit more beneath the surface, a lot of it has to do, of course, with Goldman's call on Apple. We do have the shares of Apple up more than 2%. The first buy rating for Goldman in more than 6 years. A $199 price target, actually really near session highs, up 2.6%, suggesting about 30% upside from current levels. The diversified or the installed user base for iPhones, that it could really help them diversify more so into services and to weather any economic downturns. The Bloomberg Commodity Index down 1%. Now, on the one hand, you could say this is risk off because those are risk assets. On the other hand, it means that the input cost inflation is going down. We also have the benefit of yields going down just a little bit there. And then take a look at the dollar index. It's about down 0.2% as the euro dollar goes up just a bit. Now, as for the S&P 500 itself, when we go into the Bloomberg terminal, we will take a look at a chart that we've been looking at for quite some time now. And it appears as though the S&P 500 is actually holding support. Last week, it was starting to feel a little bit dicey, but at this point, we do have this sideways to uptrend that we've been watching. Here it is marked in blue, and I've taken out the secondary uptrend since we are actually definitely bouncing off of this uptrend. We're bouncing off of support at 200-day moving average. There is a bullish wedge in here that we had marked last week. That's basically a culmination of the near-term selling power, suggesting that we will see the S&P 500 go back toward its new high, possibly above, and maybe even much higher. You could maybe make the case that this is the beginning of a bottoming pattern. I know that Mike Wilson over at Morgan Stanley, he's at least saying now, conceding within his bearish call that there's going to be a near-term rally. This chart might suggest that it will be a little bit more than near-term, but let's see it. At least right now we do have the S&P 500 going higher. As for Credit Suisse, not so much. If we take a look at a one-year chart, it's the exact inverse of this chart. Credit Suisse really having a rough time. And of course, now we have the news that David Harrow of Harris Associates is out. The stock over the last year down 56%. This is really pretty incredible, Guy, to see this and to continually get a stream of pretty bearish news on Credit Suisse.
You want to watch an even more painful chart? Take a look at what is happening with Credit Suisse versus the rest of the European banking sector. That is pain. Abigail, thank you very much indeed. Abigail Doolittle, let's get more details now on what is happening with Credit Suisse. We're joined from Zurich by Bloomberg's finance reporter, Marion Haftemeyer. Marion, isn't the biggest story here actually that David Harrow held on to this stock for way too long? It's taken him such a long time to sell. I appreciate that